So we were on investment appraisal, and we started with the techniques for appraisal of investments, and we considered the issues about the payback period, where we spoke about the fact that how long it takes for the inflows to pay for the initial cost of the project. And we mentioned that the decision rule here is that the shorter the period, the better it is for the company. But we mentioned this has some limitations, that it doesn't consider the time value of money, then it also doesn't consider the cash flows after the payback period. So we said in that case, a new module was used, and that is called the discounted payback period, which we said we're going to look at what? Take into consideration the time value of money to be able to consider the how long it takes for us to get our initial cost of the project. So these are what we discussed in relation to, I think these are the two methods we considered. So let's move on to the third one, and that is going to be the accounting rate of return, ARR. Accounting rate of return. Accounting rate of return. So this expresses profit of projects. This expresses profit of projects. This expresses profit of projects as a percentage of initial capital outlay. This expresses profit of projects as a percentage of capital outlays. As a percentage of capital outlays. Now, the idea about the accounting rate of return is that generally we say that the formula for the accounting rate of return is equal to the average annual profit. Now, this average annual profit is profit after depreciation divided by the average investment. Average annual profit divided by average investment. Now, chances are you're going to be doing workings for both the two. Now, if we say average annual profit, we will come back to that. But when we say average investment, that is AI, the average investment equals the initial cost plus any working capital plus the scrap value divided by 2. So that is the formula for the average investment. That is the denominator. Now remember, because this is percentages, it must be times 100. Okay? The answer must be times 100 because you must leave your answer in percentages. Now, what is the decision rule here? The decision rule here is that we compare the accounting rate of return to the company's cost of capital. So if it is greater than the company cost of capital, then we say what? We accept the project. But if the accounting rate of return is less than the company's cost of capital, we reject the project. That's the decision rule. Now, what did we say was cost of capital when we were doing business finance? What is cost of capital? You remember what we said?
Yeah.
What did we say?
The cost of the item plus any other cost, like installation cost, transportation cost. Is any other cost incurred?
Wait. Any other cost incurred?
In
Cost of capital. You are trying to give me FR. Initial cost of an asset. Gentrocha.
cost of capital.
Tomorrow you come for FR class.
Oh, you should let me settle down. Hey,
I'm telling you.
I don't like what you are doing to me. Oh. Hey, this is in the end.
Okay, so we are continuing with the methods. We are looking at accounting rate of return. Yes, cost of capital.
The rate of return.
The rate of return for the providers of finance. Right. So because we were thinking about FR rather, cost of an asset. So when it started, I said, no, this guy's mind is in FR. So the decision rule is compare the accounting rate of return against the cost of capital. So if our providers of finance require profit of 20% or returns of 20%, and the project we are going to put the money inside, the return is 25%, then it's a good deal. Because after making the payments to them, we're going to be having some money left. So they are asking 20% and the project return is 25%. So when we pay them, there will be 5% left. That is why we will accept the project if it is more than the company's cost of capital. So the reverse is true. If our providers of finance are requesting 25%, but the project is giving us only 20%, that means you're a bocker. So in that case, we reject the project. We reject the project. So that is the idea about the issue in relation to. I was talking about the decision rule. So I said if your accounting rate of return is greater than the company's cost of capital, you accept the project. Then I gave an illustration that if your shareholders or bondholders are requesting returns of 20%, and the money you go and borrow, when you put it in the project, the returns on that project is 25%, then it's more than how much you are going to be paying. So in that case, what? You accept the project. So the reverse is true. If it is less than the company's cost of capital, then you what? Reject the project. Because we are requesting 25%. And the money you are going to put in the project, that project is making a return of only 20%. That means boka. So in that case, you reject the project. Does it make sense? So that is the idea about the accounting rate of return. Now I'm going to use the second question we did last week on the how do we call it? On the discounted payback to solve this question. On the discounted payback to solve the question. Question and read it to me. Let me see if I can use that. What do we have? The question we solved for, we used to solve the discounted payback period. But you have that. But I gave a question on that.
Yeah.
So read it for me and let me see.
ACCA PLC invest 120,000.
Okay.
No, that one is 185. The payback was the 120. The discounted
Okay.
is 185.
Uh-huh.
Into a new project.
Okay.
With net cash flow as follows.
Okay.
Year 1.
Okay.
50.
So add all the cash flows for me. That gives us the total cash flows.
And the cost of capital is 12%.
Okay. What we got? 254,000. Okay. Was the asset having any scrap value? From that question? No scrap value. Now, remember what we said here. ARR is average annual profit. So, to calculate my average annual profit, I need my total profit. So, what is total profit? Total profit is total cash flow minus what? Depreciation. Now, in this question, what did they say? Net cash flow, isn't it? Meaning they've already dealt with what? Issues about depreciation. Net. So they've dealt with everything. So we won't talk about it here. So meaning the total profit is 254,123. Now, we need to get average annual profit. So the average annual profit, APP, will be equal to, what was the life of the project?
6 years.
So that's going to be 254,000 over 6. What we got? That is the average annual profit. What do we have?
42,333.3.
So 42,333. So that is the numerator, average annual profit from this question. Then the denominator, average investment, AI. What's the formula for average investment? Initial cost plus working capital. In the question, was there any working capital?
No.
So the initial cost is how much? 185,000 divided by 2. What do I have? 92,500. Okay. So let's get the accounting rate of return. So the ARR, which is what? Average annual profit, which we've had here as 42,333 divided by the average investment, which is 92,500 times 100 will give us what? 45.7%. 0.76. So we can say 45.8%. Should we accept the project based on accounting rate of return? Yes, because it's bigger than what? The company's cost of capital. That's the idea. That's the idea about accounting rate of return. So you can write that, refer to that question, and you put it down. And let's continue.